we've been working on it for a couple of years now. It's not something that's brand new. We do have like a complete catalog of podcasts, videos, old webinars. And, obviously the idea is, like I said before, is we love talking about real estate, and we want to do everything that we can to get the word out.
So let's start off tonight. We're gonna get into this article on Money Magazine, but we're gonna do just a quick market review, just go over some quick statistics, see what's going on with the housing market on a national level. Pending home sales rose 1.5% in March, so good news there. Pending home sales were up 7% from March 2012, making the 23rd straight month that pending home sales have shown a year-over-year increase. So
it really did seem like last year was, for us in particular, was a little bit stronger than 2011. And, then now we're getting into 2013, it seems like things are rolling even a little bit more, which is great news.
We always talked about, just within our business and our market, really the bottom of the barrel. We think that the market really bottomed out summer 2010.
Yeah.
Summer 2010 was about the low. I mean, the market was
You think about
so
the first-time homebuyer tax credit going away.
Yes.
And then, boy, it just really did not get a whole lot better from there. And, now from what a lot of the economists are saying is that the market is starting to function like a market should, where you have supply and demand. It's more of a properly functioning market. And as a matter of fact, right now, another phenomenon that's happening in the market is that we're experiencing a shortage of inventory.
Exactly.
So, there's really right now the fact that we're massively underbuilding as a nation and as a market here in St. Louis, and the fact that there's a lot of people that are sitting on their homes that can't sell. Maybe they're underwater. There's really not enough housing inventory to take on the buyers right now. Which is, it's strange to think about it because as bad as things got, it does seem like a turnaround now that, we're talking about listing your property and selling your property being a little bit easier than it was.
And this next stat actually goes right into that. 1.93 million previously owned homes were on the market in March, representing a 4.7 months supply. So that's actually an undersupply, 4.7 months. I remember back in 2006, 2007, they were talking about an 18-month supply.
Yeah, year plus, absolutely, for years and years.
From what we understand, they say about a 6-month supply is about where the market needs to be healthy. So existing home sales in March were up 10.3% year over year, 10%, pretty amazing. Median existing home price was $184,300 in March, up 11.8% from March 2012. Distressed homes, foreclosures and short sales accounted for 21% of March sales, down from 25% in February.
And that number's way, way down.
29% in March 2012.
At one point, we were almost half.
Correct. The median time on market for homes was 62 days in March, down from 74 days in February and 91 days in March 2012. So that kind of goes right into what you were talking about. It's actually starting to become a better time to sell a house.
If there's people out there that are thinking about selling now, it's really the time to do it. With the inventory shortage, with the interest rates still being as low as they are. If you're on the fence now and you think you want to move, really, really would encourage you right now to reach out to a professional and see what your house is worth and see if it makes sense to put that thing on the market because they're selling.
And there's also a lot of incentives out there for buyers. We're seeing the grants coming in from the state of Missouri. We had a buyer that's getting ready to close. What's he getting?
$14,000.
$14,000 in
down payment. About 10% of what he's paying for the house in down payment assistance from MHDC, which is money from the state of Missouri.
So as buyers continue to take advantage of those type of programs as well as low interest rates, it's in turn becoming a much, much far better market for sellers than we've seen since 2007.
Agreed.
There were 1.2 million homes at some stage of foreclosure as of February 2013, down 21% year over year, and 54,000 completed foreclosures during the month, the lowest figure since September 2007. So the number of foreclosures are starting to slow up a little bit. And that's interesting because, more of a regional level or a state level, we read some information this week in Missouri, believe it or not, over 1 in every 4 homeowners underwater. 1 in 4, and that's pretty staggering for sure to think about.
It really is.
As far as percent of total loans in foreclosure, We have 14% that were loans that were originated before 2003. From 2004 to 2008, that's 75% of the foreclosures. So that was the big problem right there. You got subprime in there, you know, all the different type of crazy loans that they were doing, the 80-20s, 100% financing, 103% financing.
And there's still a lot of that inventory that still has to make its way through the market. You know, and that's something that you really have to think about too. Even though these are old foreclosures, they're still there.
Right.
They still have to hit the market. They still have to be sold. So, you know, in a way, that is still at least slowing the recovery some, and especially in some areas where you have certain neighborhoods, zip codes, et cetera, where maybe the subprime market went real bad, or there was a lot of those subprime loans. And some of these areas, like it seemed like the whole neighborhood went into foreclosure.
There's a lot of vacant houses still in St. Louis.
You think about some of those areas, and if you're looking at an area where, you know, 2 out of 3, 3 out of 4 homes, you know, in the neighborhood have been through the foreclosure process, and you know, expect some type of a sharp recovery in that type of an area, that might be a little bit difficult.
So even, you know, down to a more of a regional level, we're going to talk a little bit about the St. Louis market. There's actually a report, an overview that we pulled, actually published by Solomon Gershman, which is a St. Louis firm. And, you know, it talks a little bit about what's happening in St. Louis right now as far as the economy, not just housing. So the Federal Reserve reported that consumer spending grew at a moderate pace in 2012. While manufacturing has weakened nationally, the St. Louis district remained positive. St. Louis cited stable wages, but added that non-labor costs in manufacturing are rising. So that's pretty cool.
That's awesome.
We have more manufacturing jobs in St. Louis. We're actually producing some goods, which everybody likes. St. Louis has reported a net decline in non-financial services, but has an increase in categories such as telecommunications, business support, legal, crisis management services, and casinos. St. Louis is the 19th largest metropolitan area with a population of more than 2.8 million people. We have a workforce of 1.4 million and over 1.1 million households. St. Louis is recognized for its superior business climate and highly skilled workforce. St. Louis serves as a national headquarters for 20 Fortune 1000 companies, 8 of which are Fortune 500 companies. And our Fortune 500 companies that have their headquarters in St. Louis are going to be Express Scripts Holding, Emerson Electric, Monsanto Company, Reinsurance Group of America, Peabody Energy, Ameren, Graybar Electric, and Centene. And this is a really cool stat. I thought one that I wanted to talk about. On average, 2,340 jobs per month were added in the St. Louis metropolitan area in the first 10 months of 2012. So 2,340 a month compared to just 440 jobs per month, which were added in 2011.
That's good stuff. And you know, the job market couldn't be more important, even whenever you're comparing it with the real estate market. You know, it's one thing about St. Louis is that we're located in the middle of the country, so we feel that logistics is going to be strong in St. Louis, and that's something that's going to continue. We do have lots of universities, and we have lots of major hospitals. In fact, you know, there's people that come from all through the Midwest to come to some of our hospitals to see specialists. Barnes, Children's, Cardinal Glen. There's a laundry list of them. But you know, the healthcare jobs, the transportation jobs, the manufacturing jobs, those are really the kind of jobs that we need in our market to help with an economic recovery.
And that in turn should definitely help out housing. You know, whenever they're bringing jobs here and you have more people that looking for a place, you know, for a roof over their head, that in turn is going to help the housing market. It's going to help investors, anybody that's owners out there.
It's going to help the rental market. You know, people that are going to rent these properties out, you know, they got to be making money in order to pay their landlords.
Mm-hmm.
So, I mean, the fact that St. Louis, our job market is holding strong, and we're getting lots of positives in the job market, coupled with the fact that affordability is really good here still, that you can still buy a nice home for not a lot of money, that we think that's helping the real estate market, and it's definitely bringing the investors in.
And actually, there's one of the slides in the Money Magazine article talks about 2 different type of recoveries, and we're going to get into that, and that kind of coincides exactly with what we're talking about right now.
It does.
Okay, there's recoveries because the economy is going pretty good, and there's also recoveries, real estate recoveries, just because investors are just coming in and snatching up properties.
And maybe St. Louis has a little bit of both.
I think so. But I think if you get, you know, some of the markets that have really performed performed well, it's more people coming in and snatching up properties. We're talking about the California markets, Las Vegas, and so forth.
Right.
All righty. Okay, so let's get right into this article, this Money Magazine. Housing is back. Look at that great house, blue skies,
Beautiful.
everybody's happy. 6 years after prices collapsed, housing has begun to climb out of its hole. Whether you're buying, selling, or staying put, here's what you need to know about the market. That's finally on the rise. Gosh, it seems like we have just been given bad news for so long whenever it comes to housing.
It almost seems weird to hear good news.
It does.
Especially from the media.
We got so used to just being the Grim Reaper, going in and just pounding people and saying, oh, your house isn't worth that, your house isn't worth that. And we hate to be the bearer of bad news, but we're going to tell you the real deal.
And you can't change the market. I mean, not one company. No matter how talented you are, no matter how good your marketing is, as a real estate agent, you can't change the market.
So the big picture, according to Money Magazine, the nationwide real estate recovery is for real. So thanks to low prices and historically lower interest rates, 3.67% for a 30-year loan, homes are more affordable than they've been in 40 years. Result, sales are moving up. And I wanted to mention also that this is actually the April issue of Money Magazine. So I think interest rates are still pretty close to that.
They're still low. They
low.
Bumped up a little bit and gone up and down a little bit, but very, very important and exciting for us is the projected average of what the real estate's going to sell for. You know, it's moving up. It's not going crazy. It's not going up like it did back in the heyday before the housing bust. But, you know, we think that if we own real estate and we can expect to gain 3%, 5%, 8% a year on our investment, I mean, that's really, really good news for us.
Correct. I think that, you know, the low interest rates, and obviously there's certainly a caveat when it comes to that, something that's worth mentioning is it's just very difficult to get a mortgage these days. And that's, I mean, the standards, the lending standards as far as the credit, debt-to-income ratios, it hasn't loosened yet.
No, it's very tight.
Yeah.
And, you know, if anybody's out there and they're working on buying a house, just a little word of advice, and this kind of comes more, you know, from what's been happening personally with us in our business. If you're trying to get a mortgage, just expect the unexpected because, you know, these underwriters are double-checking, triple-checking, quadruple-checking these files. And I've got a couple of choice words for underwriters right now that I'm not going to say. But, I mean, almost in some cases, it looks like they're coming up with reasons not to fund these loans.
They're just really scrutinizing the borrowers, and you know you can understand why they are, I guess, in a certain respect, and
because they got hit so hard.
They're getting pressure from the government. Everybody wants them to you know loosen their standards, but they aren't loosening.
They're not loosening, and it's every little tiny thing. I think they want to know what you had for breakfast the day of closing. I think they want to know what your shoe size is before they fund that loan. I mean, it is literally crazy.
A little ridiculous.
It is. I mean, and it's unfortunate that consumers have to be, you know, put through this in order to buy a house. But it goes back to, you know, again, it's the way the market is right now, and you really can't change it. You just got to be able to roll with it. So anybody out there that's looking to buy and you're looking to obtain a mortgage, just, you know, flow like a butterfly, sting like a bee. You have to have some flexibility there because if something weird is going to happen, if you think something weird is going to happen, it probably will.
And try to do business with a regional bank also. The big five.
I know.
I mean, that's, you know, Bank of America, Wells, Chase.
It's like pulling teeth.
It's very difficult to get anything done. You're dealing with underwriting departments that are so completely overwhelmed. I mean, they're completely overworked, understaffed. Someone told me that every underwriter is working on 50 files at a time.
And, you know, trying to get a deal closed on time, forget about it.
Right.
There's no way. I mean, it's contract extension after contract extension right now. And, you know, it's very, very unfortunate that that's the climate, but that's what it is.
You know, but the good news is you know, the recovery is definitely at this point 23 months in a row. I mean, it's happening. It's definitely happening. So it's something to think about, you know.
And there's going to be a couple bumps in the roads. You know, I mean, you look at the foreclosures, you look at how hard it is to obtain a mortgage, and for us, those are still going to be two very important factors that are going to affect the market moving forward.
Most markets are going to gain modestly in 2013, so price increases are forecast for most of the country. But the bulk of cities are likely to have muted gains in line with inflation. Only a few cities are projected to show big advances, and that's mostly in California. The weakest outlook among big markets, the 1.7% decline for Stamford, Connecticut. So, you know, St. Louis is going to be in that middle 75%, but still 2.1%.
Better than nothing.
We'll take it. I mean, it's better than losing. I mean, we're down 25%, on a whole as far as where we were during the boom. So any type of gains that you can have for being an owner out there is appreciation is just, it's icing on the top.
It is.
When it comes to being a property manager, and people were actually buying, we saw it, people were buying homes, rental properties, and they were negatively cash flowing these properties because they were banking on appreciation.
They wanted the appreciation.
Yeah, I mean,
that's the thing in the past.
It is. It seems like such a ridiculous business plan to actually do something like that, but the amount of appreciation in some of these markets, you talk about a Florida market or, California or, Phoenix, these markets were just going gangbuster, that people were just doing everything that they can to have their name on a deed.
And the shame of the thing is that all that money was funny money to begin with, and we know that now. But we still feel that, having your dollars in real estate is a very, very safe place to put your money. We think over the long haul, it's very difficult to lose in real estate. Real estate's a great investment because you can actually make money off of it by renting your investment out. So, I mean, you can actually make income off of an investment. There's a lot of tax benefits to owning real estate. So over the long haul, even as bad as the market got banged up, we still feel that putting your money in real estate is important for every investor, big or small.
So this is what I was talking about earlier. Two types of markets are behind the turnaround. Prices are not rising for the same reason in all city. Some markets, the rebound reflects a strong local economy, which we're seeing some of that in St. Louis, and others the increase are driven by bottom fishing. These extreme price declines. Investors are coming in and they're just trying to buy everything up, right? I mean, we actually, from what I understand, we have a REIT that's operating in St. Louis now. REIT is a real estate investment trust, it's like a hedge fund. That they're coming in, they're trying to buy everything that they can. And they're banking on properties appreciating. They're banking on the strong rental market, that we're seeing right now. So we might have some of that, of both ends of that in the St. Louis market.
I agree 100% with that because we are seeing some growth in the jobs market. We do have some real stability when it comes to large companies in the market. Where we're located in the country helps us. We're located on two major rivers. That's something that certainly helps us. So there's a lot of good economic forecasting and aspects of St. Louis to talk about. But then on the other end, there's still a lot of cheap housing, and that's a reason that a lot of people are coming in, even from out of state, even from out of country, and buying real estate in St. Louis. Very, very interesting for us.
So if you look on this stat right here, if you look in Seattle, 19% absentee buyers share purchases. So that's pretty amazing.
A lot of out-of-market buyers.
It really is. It really is. I mean, 19% just seems like a pretty high stat for buyers that are whether it's second homes or investment properties or whatever they're doing. So pretty interesting. Different types of homes are making different gains at different rates. And this goes into the condominium market, which did awesome during the boom. Everybody was flipping condos in Florida. You heard all this.
Oh, yeah.
The price hikes that mostly outpaced those of single-family homes during the boom. Says during the darkest days of the bust, however, the trend reversed. In earlier days of the rebound, condo prices have continued to lag. And this is no surprise to us.
You got to be very, very careful when you're buying a condo. I mean, and there's things that you can do to protect yourself, obviously. You can review the condo association's financials. The number of rental properties in each given unit is something that's going to come into play. But bottom line, if you're out there and you're in the condo market and you want to buy a condo, nothing wrong with buying a condo. In fact, we own a condo that we've used for an investment property. It's been a real solid property for us. We've never had a problem filling it. It's a really nice property. But bottom line is, if you're going to buy a condo, be careful, do your research, make sure that you take a really, really close look at the condo association and what's going on over there. The big problem is if you get a condo association that's not doing their job, or if you buy in a unit that has a bunch of rental properties, you might have purchased or bought a unit that cannot qualify for FHA, VA, or conventional finance.
Sometimes even conventional.
So you got a unit that you can't sell.
Right.
So it was, maybe for someone that is never going to move, maybe if you want to buy a condo and rent it out for the rest of your life, great. But if it's someone that might need to sell that property down the road, you might be stuck with a problem.
Yeah, particularly with the FHA and the VA, like you mentioned, if the condo association is they review the financials to have FHA approval. They have to have certain types of insurance. They don't have the right insurance policy. FHA won't insure the loan. If people aren't paying their condo fees, if too many of the people, the tenants there are behind, that can hurt them also. And then also about the investor-owned properties. There's actually one complex in close to our office out here in St. Charles that it's a nice complex. It's a real nice complex. The units are great, but you cannot get financing of any sort on this place because there's a builder in St. Charles that owns 25 of the units. He actually bought the units because he was building a neighborhood out here, and he put, the people that he was building for, he allowed them to rent out these units, and he just never sold them and hang on to them. But that one thing, there's nothing wrong with the condo association. Everything's golden with the condo, but that, because there's those units that are investor-owned, no one's going to get
that one bad number on the books.
Right.
It takes all the financing completely away from those units. Crazy.
It does. It seems pretty ridiculous, but when you think back about, how bad the banks got beat up with those condos, that was rough. So there's plenty of room for improvement. Still plenty of room. The housing revival is far from over, and this is the forecast of Trulia's housing barometer. We don't have any idea how they get these numbers, but we're still going to talk about it. Measures the market's health based on construction starts, existing home sales, troubled mortgages, scale of 1 to 0, 0 at the bottom, and 100% is of normal pre-bubble activity. The current reading that we're at right now is 31% as of January 2012, and that's probably gone up.
Yeah, we still got a ways to go.
We do.
There's no doubt about that. But just even to look at the housing starts and how low they got back in in 2010, 11, 2009. I mean, we were hardly building anything. And out in St. Charles, where we live, I mean, how many of these builders went belly up?
Pretty much all
Probably
of them.
2 dozen.
Yeah, except for the big one. Except for the big ones.
Yeah, the McBride, the Jones. I mean, some of them were able to make it through, but most of these little guys are now gone. They're doing something else now. It just got to a point where there wasn't any money in it.
And it's pretty typical for the new construction market to follow the existing, the existing home market. People start buying existing homes, and that gets better. Then the builders are more comfortable. They can get a little bit more money from the banks in order for them to start building.
So it should pick up.
It definitely should. So they're saying a continued recovery. This is something that we've talked about a lot. It's not like it goes from a buyer's market to a seller's market overnight. It's not how it works. There has to be some type of transition, and we really feel that we're in that transition at this point because the housing, the bubble, the housing market got so bad. I mean, it could be a very, very long transition for it to really get back to a really strong seller's market.
It could literally be like a number of years, where it's not really a buyer's market and not really a seller's market. And, quite honestly, a lot of it is going to depend on what happens with the inventory. I mean, right now it seems like it's maybe even a little bit more of a seller's market than it really is because of the lack of inventory.
Right.
So you throw that in the mix too. And then you also have to think about some markets recovering faster than others. We've heard some negatives coming out of some like the major metro areas where we've seen a big spike of foreclosures, even here in St. Louis, Chicago, New York. Vegas is one that comes to mind where you have these big markets that have really not been able to completely tackle the foreclosure problem. And in fact, in some of those markets, the number of foreclosures have actually started to go up recently.
So this the map here just kind of goes through some of the markets that have seen the biggest 5-year gains. I remember Stockton, California. I remember that during the mortgage meltdown, the subprime bust. Stockton, California was where subprime was actually invented. Okay, so they got hammered.
I think the homes out there were going up, double a year, triple a year. I mean, obviously it's probably a very beautiful city. I've never been there, but they went up so fast, only to just have the whole market actually being pushed right off a cliff.
Okay, so this is kind of a cool looking slide here, and we're going to talk now about insurance, and obviously something that the whole country's been dealing with, particularly Oklahoma, Joplin. We see these massive stores coming in and doing all this damage, property damage, loss of lives, which is terrible. But the insurance companies are reacting. They are reacting, and it's important for anybody out there that's a policyholder that has an insurance policy on one of their properties to make sure that they know what's going on at this point.
It's such an easy thing to blow off because you don't think about it. It's all being escrowed and coming out of your mortgages. At least that's the way it is for us. So it's not really something that a lot of people are going to take the time and energy to review. But we're telling you right now, take the time to look at your policies. Get together with your insurance carrier. Go over these policies. Make sure that you have the right type of insurance. Make sure you have enough insurance. Maybe you have too much. Who knows? But taking a look at these policies and figuring out exactly how you're insured is something that's very, very important.
That's something that has always been odd to me is when I talk to clients. And I know kind of ballpark what you should be paying for an insurance policy. Let's say we got a house worth $100,000. We probably pay $600 a year, $700 a year, something like that. How come some people have houses that are worth less than $100,000 and they're paying like $1,400 a year? How does that happen?
They're obviously getting ripped off. And you hate to say that, but that's just like throwing money out of the window, especially if you're trying to cash flow a property. That comes right off the top.
And we're not, insurance experts. We don't know everything about insurance by any means, but what we're saying is make sure that you know what you're paying for. Make sure that you know what your policies. Do you have earthquake insurance? Do you have sewer line insurance?
Right.
All that kind of stuff's important. We got burned with the sewer line.
Flood insurance.
Yeah. Exactly. Flood insurance if you need it. So.
Yeah, absolutely. And you know what? And we're actually very happy with our company. Worth Country Financial, and they've always been real good.
They have.
They've been great. So again, we're not trying to beat up insurance companies, but you look at what's going on, especially this slide. It leads right into this slide. You look at how many bad storms, major occurrences have happened, and how they picked up over the past 10 years. The companies are going to have to raise premiums, offer a little bit less coverage. They're not going to break, but they're certainly going to have to bend.
They have to do something to deal with this, right? So, average homeowners premiums $900. That really sounds about right.
Right.
I think that's pretty typical to what we pay. But if you have a house that you think's worth $85,000, $100,000, and you're paying over $1,000 a month in insurance, I think you need to look at that.
I do too.
I think you're overpaying for your insurance. A lot of times if it's a brick structure or whatnot, they want you to come in and insure for replacement costs. If you have a brick house and it's in St. Louis County and it gets blown away or burns to the ground, total, 100% loss, you're not going to put up another brick house.
No, you build a frame house.
You would build a frame house. They rarely even build brick houses anymore. So why would in the world would you need to carry insurance to put up a brick house when you know good and well you're not going to do it?
The replacement cost is probably where they get a lot of people, especially in these older buildings.
Right.
Because, what would it cost to, as expensive as bricks are now, what would it cost to rebuild one of those, two-story brown house type homes?
Oh, the brownstones would be ridiculous.
$200,000, $300,000, $400,000 to rebuild something like that.
Mm-hmm.
And you're talking about a house that's worth $100. A property that's worth $100. So you're really kind of kicking yourself a little bit if you're insuring replacement costs on those, especially those older buildings in a lot of cases.
Right. So that's going to be the end of the Money Magazine article. We want to really thank everybody for joining us tonight. We really appreciate you listening to us, listening to our presentation. Take a look for more webinars coming, and also just to announce again, all of our webinars and podcasts you can find on YouTube. Just go in and search YUEDE Team. You can listen to all of our presentations. We actually just did a really informative webinar with one of our good friends and business associates, Chris Winterhalter. He was kind enough to come and talk to us about his what he's doing with real estate in St. Louis and what happened in his business. And then we're going to be interviewing another one of our clients in an upcoming webinar.
Sometime over the summer, we're going to be interviewing Greg and Sarah Miller, and they're also friends of ours. And they're buying real estate. They own the place that they live in, but they're also buying investment property. And Greg is a real sharp guy. He's got a master's degree from Purdue. And one thing that he said to me, and this was actually a couple of years ago, we sat down. He said, I think I want to buy an investment property. I said, that's great. That's a great goal. And just kind of thinking to myself, this guy's got a good job.
Yeah, they both have jobs.
IRAs, the whole nine. They have retirement in place. And I said, what's the motivation, Greg? And what he said to me really stuck in my head. Even years later, he said, Sarah and I sat down to review our financial status, whatever picture, whatever you want to call it, and in talking with her and I felt that there was no way that we would be where we wanted to be if we didn't buy real estate. And that's verbatim what he said. And very, very poignant words. That's something that stuck with me. And, I think about him saying that a lot, especially as I'm giving other people advice. So we're looking forward to interviewing them. They're really good, smart people. And then, if there's anybody out there that's listening to this presentation, whether you're listening tonight or you're listening to this recording or another one of our recordings, if there's ever a question about anything, please call us. I mean, we'd love to talk to you about buying or selling a house in St. Louis. We'd love to talk to you about investment property or managing a property, whether you want to buy 100 homes or whether you want to buy one house. We'd love to have the opportunity to earn your business, and we really appreciate everybody taking the time to listen to our presentation.
Everybody have a great Memorial Day holiday weekend. Be safe, and we will look forward to our next presentation.
Good night, everybody.